right. That's super interesting.
Yeah.
Okay, Jordan, let's get into your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, everybody has probably been screaming this whole show and being like, when is he going to talk about Propel Holdings? For some reason, you are the bucks on Propel Holdings, which is another one of these online lending platforms, and this is your first pick.
Correct. I think we've been talking about Propel both on BNN and in our writings since the IPO in 2021. So we've owned the stock since then. It's been a fantastic winner despite the recent share price performance, which we'll talk about. It's an incredible business. I don't know how much you want to get into what they do versus, what's happened lately with the stock.
Well, let's do both. We got time.
Let's do both? Okay. So unlike GoEasy, that actually has physical branches and does a bunch of different things like credit cards and auto financing, Propel's focused exclusively on consumer lending. So most of their businesses in the US, they've got a small business in Canada called Fora that competes with GoEasy because, as you may know, Canada has interest rate caps now at 35%. Most of the businesses in the US, so it's US consumer lending, but it's online consumer lending. So they don't have any physical branches or anything like that. It's all done online, and it's done through technology that they've developed internally over the last 13 years or so. Toronto-based company, listed in Toronto, growing like crazy. They just bought a lender in the UK, so they're now going to do the same thing over there. So you've got Canada, the US, and the UK, but US is really the majority of the business.
So a lot of 2021 IPOs, they went up and then they came down. They either never came back, they're still struggling, or they've been bought out. Propel is not that. Propel went well above where it debuted in 2021. And even though it's pulled back huge, it's still above those levels. I want to know, why did it pull back so much? I'm just going to make my numbers on my chart on my Bloomberg, and it's lost 50% in a couple of weeks.
So this goes back to your question before. So let's go back to the beginning, which, lucky for us, is not so long ago. It's 2021. So company comes out. I think the IPO was $9.75 a share, if I'm not mistaken. We participated in the IPO. It was a really hot market. If you can remember Q4 2021, we were seeing a ton of financings. The market was ripping. Everybody was making money. Stock quickly went to about 14. So we bought a little bit on the way up. As I described to you earlier, we kind of like to buy as stocks are going up. So we buy a little bit on the way up. So we had bought some at 9.75. We had bought some around 11 or 12. It hits 14. Everybody's happy. Our cost base is probably 11 or whatever it is, 10.50. And then we get the 2022 market, which was not kind to equities. It was not kind to small caps. And really, regardless of the quality of the company, stocks were being sold down. So all of a sudden, the stock went from 14 to 6. And I distinctly remember the fall of 2022, looking at the company and really scratching my head because the operating performance had been great, but the stock went from 14 to 6. And at the time, on my numbers, I was going to buy the stock at about 3 times earnings at $6. So this is 3 times earnings. And this company had been doubling profits every year for the last 3 years. It had a dividend. There were no issues with the company. And I'm getting calls from brokers every day offering me blocks of stock, 50,000 for sale, 100,000 for sale. So we start buying a lot of stock, and actually becomes our largest position in the fund in 2022. And I'm wondering why nobody wants to own this stock except for me. Me and maybe a few others. And then we get into 2023 and the markets start to rebound. And through 2023 and 2024, the stock went from 6 to 43.
Wow.
Okay. So it went on a huge run. And basically what happens was, going back to our earlier conversation about multiple expansion and getting into these stocks when they're trading at low multiples, the multiple went from 3 to about 11 or 12 at its peak. Okay. So up to about a normal multiple in that $40 to $45 range. Now I'll get to your question. So what's happened since then? Well, people have gotten concerned about the economy. People have gotten concerned about the consumer. I still don't think people totally understand this business. And I think part of the reason is Canadian investors love their banks. I've talked about this a lot before. They love their banks. They love their insurance companies. Usually their equity portfolios are full
Well,
of those.
They don't drop 50% in a few weeks.
Sure, but they also don't 5x in a year. So where do you want to be? Right? Do you want to own? You probably want to be in both places. But getting back to the conversation, people get worried. I think people are so full of financials that there's not a lot of players even looking at these stocks to begin with because of just the market structure in Canada. But there's some amazing companies that you can find in these non-bank financials, these niche lenders. Okay. So people get worried about the economy. People maybe don't understand Propel's business entirely. I know some people called and asked me if there were tariff issues. There's no tariff issues. They're a US lender. They don't actually make anything. These are loans, but it just goes to show you the things that people worry about. And then I think there was also been a lot of faster money in the stock that has been playing quarters. So I think what might have happened, and I have no way to confirm this, is you had some people who were coming into the stock for the quarter, Q4. The quarter was good, but the stock didn't move. So now these fast money players will exit. And what happens is then that will set off some of the machines, the algos. Then that will upset the retail investors who all of a sudden are looking at a stock that's down 20 or 30%. So now they're selling. And going back to what I was saying a few minutes ago, they're responding to price action without actually looking at what's going on in the company. If you look at the Q4 earnings release, the numbers were spectacular. And the guidance for this year is also spectacular. This company is giving guidance for a 30% return on equity. I don't think there's many companies, if any, in Canada that are doing that. So we have a very high growth company that's operating in a very large market, just in the US. Now we have UK and Canada as well. You've got a nice balance sheet. Right now, their cost of funds is a little bit high. They're working on drive that down. So that'll be another catalyst. They've raised their dividend, I think, 6 times in the last 4 quarters. What I've said before about this company is it's something for everyone. If you're a growth investor, it's got a very high growth profile. If you're a value investor, you're buying the stock right now on 6 times earnings. Okay. If you like dividends, it has a dividend. So there's a little bit of something for everybody here. I love this company. I think you're going to see over time, and you can, hopefully we're still doing this podcast in 3 years or 4 years. I think this is actually a $100 stock.
Okay. What's it at now? 23.
23. And I'll tell you quickly how we're going to get there. Right now is about $4 a share of earnings. If they can continue to grow at 30+% a year, if you do the math in 3 or 4 years, that gives you about $10 a share of EPS. Put a 10 times multiple on that. This is a $100 stock. I think we're going to get there. Unless something crazy happens, we're going to hold the stock until then. And let's talk about it again in 3 or 4 years.
All right, we're going to do that. I'm going to hold you to it. Let's go to your second one. The second one is Source Energy Services. It's an energy services company, swung to a loss in its most recent quarter in February. And I think that's when the stock pulled back.
Yes. So this is another kind of interesting business that, I probably wouldn't have ever thought I would have owned something like this if you would have asked me 4 or 5 years ago, but somebody showed it to me 2 or 3 years ago. I didn't think I would like it. They're a frac sand company. So they're one of the leading providers of frac sand in Canada. They mine the sand in the US and Canada, and then they sell primarily to Canadian large E&Ps, names that your viewers would know. And at the time that I saw it, what kind of intrigued me was during COVID, there was no drilling. So sand prices collapsed, and they have fixed price contracts with their customers. So they were writing these contracts at very low prices in 2020. By the time I saw it in 2022, those contracts were rolling off, and they were getting renewed at basically double the price because drilling had come back. So all of a sudden you had a company that had a cost structure that was kind of, flat where it was, but they were about to be able to sell their product for much more. So I was kind of intrigued. The reason nobody really was looking at this is it was really small. When we bought it, it was only a 30 million market cap. So it's one of the smallest companies that we've ever invested in. But at the time, they had about 100 million of EBITDA. So think about that for a second. And we were just talking about EBITDA. I'm using that metric just because earnings wouldn't tell you the exact same picture. But we were looking at a company where sand prices were going up, and they were renewing these contracts at higher prices. They were about to start paying down debt, and no analysts were covering this thing. And I thought, this is kind of interesting. So we bought a little bit of stock down around $1.60, and over a year and a half, it went to $16. So it was actually a 10x for us. So you talk about the returns that you can get in our corner of the market. The reason you're willing to accept 50% drawdowns is so that you can get returns like that. So that being said, They had a soft Q4, like a lot of the other OFS companies. I think Q1 will be very strong because I think some of the business that we should have seen in Q4 will be coming in Q1. I think you're going to see the company buying back stock. They also did a JV with Trican last year, which is interesting. I think a lot of the companies like Trican have cited frac sand as a bottleneck in their process, and securing a supply of sand is very important to them. Ultimately, I think this is another one that could get taken out. We don't own it for that reason.
Who would be a buyer?
You could see an oilfield services company that just wanted to make sure they had supply for their customers. There was a transaction. This one was really interesting. In the US last year, Apollo, the private equity firm, bought a company called US Silica. And just to give you some metrics, at the time I did some math and I said, okay, if we took the multiple that Apollo paid for that company and put it on Source, what's the share price? It was over $30.
And right now it's 10. I love when you do the math for us.
You like that?
Take it through, but give me the answer too. Let's go to your third pick. This one is Mainstreet Equity. This is an interesting one. It's real estate exposure, but it's not a classic REIT. Help us understand what Mainstreet Equity is, how it's different.
Again, probably not a stock I would have thought I would have owned. I never buy real estate stocks because most of them are REITs, and most of them take any of the cash flows they have and they pay them out to their unit holders, and they tend to raise equity quite often to finance operations. So usually not the kind of company that screens well for me, and not the kind of company that really has what I'm looking for. So the CEO came into my office, I think in around 2020, was actually coming in for a different reason, but started talking about Mainstreet and what he was doing. And I had never even looked at this company. The first thing to realize is this is not a REIT, it's a corp. It's a corporation. So that's the first key difference. The second difference is they're not actually paying out their cash flows. They recently started a small dividend last year, but it's minuscule. And I think it's mostly just so they can be included in various funds that require companies to pay a dividend. But what the CEO, his name is Bob Dylan, has done over the years is he's taken the cash flows from his business and he's used those cash flows to buy more buildings. So it's a Western Canadian focus. So they're not in Ontario or Quebec. The good thing about Western Canadian provinces is they don't have rent control like we have here in Ontario. So if you're going to be in the apartment building business, it's better to be in the apartment building out west as opposed to here.
That's interesting because we hear a lot about the sluggishness in the condo market and units that are not selling, and REIT CEOs saying there's now deflation in rents. Is that not happening out west?
No, because the up until recently, the economies have been doing quite well. I visited their offices last May, and I had a chat with them about rental increases. And at the time, rental increases, when a tenant was moving out, they were raising rents at least 10%. So the interesting thing about this company is they were raising rents, and at the same time, the vacancies were going down. So when we first invested, the vacancy rate the company was reporting was about 7%, I think, across its whole portfolio. We saw those numbers go down to about 3%. So you had rents going up, vacancies going down. So the tailwinds were very strong. The most interesting thing about this company, though, I have to say, is they never raise equity. So they've been public for over 20 years. Their shares outstanding is the same as it was then, but the stock's gone from $1 to I think around $180, $185 today. It's been a huge Canadian success story, going from 200 apartments to almost 20,000 apartments.
And again, not through raising equity,
exactly.
Not paying the dividend. Instead,
no dilution.
Taking that cash and putting it back into the business. So on a very long term, it's done super well. Recently, it has pulled back. And we actually did a show on REITs, and the fund manager, Dina Rico at Middlefield, was saying the gaps between what these REIT stocks are trading at and the value of the assets that they hold are huge. Is that the same then for Mainstreet, or does it not really work that way?
It works the same way in theory, in that you have to look at the NAV and look at the share price and figure out if you're at a discount or a premium, and they do typically trade at a discount for a whole bunch of reasons. Mainstreet has actually, since I've been following it, usually traded at around a 10% discount to NAV, but then we did see periods, there was a big run in the share price last year where it was trading at a premium to NAV. So we've seen it kind of ebb and flow. Right now, I have it trading at a pretty large discount to NAV. So our NAV on Mainstreet right now is $253. That's based on 2026, our estimates of 2026 NOI. Net operating income is how we come to that calc. people can do those calcs different ways. They can include or exclude certain types of debt. There's different ways to come to that number, but our number right now is $253. You have a stock trading at $183, $185. So again, if you don't own it, I think this is a great steady Eddie. And I actually said to Bob, the CEO, out of all the companies we own, this is the one I worry about the least. These are apartment buildings, and these are kind of, mid-market apartments. So these are not $10,000 a month penthouses. These are apartments for everyday Canadians. A lot of them are new Canadians. A lot of them are students. But one of the things nobody talks about with this business is there's a lot of hidden upside. And I talked about this a little bit on BNN last time, but we have the core apartment portfolio, which is great, and it throws off all this cash flow, and it's really well managed, and that's kind of the core business. But we have a big problem in Canada with housing, and the problem is density. And the way that various cities and municipalities are dealing with this problem is by relaxing density rules. And we've seen this in Toronto. We've seen super high condos and things like that coming up. You haven't seen that as much in Western Canada. So if you think about what Mainstreet owns, these are mostly small apartment buildings located in downtown Western Canadian cities. So I think you probably know where I'm going with this, which is a lot of these could be condo sites. And as a condo site, they're worth a lot more than they're worth now as apartments. So there's potential for these buildings potentially to be turned into condos. That's the first piece. The second piece is a lot of these properties have excess land. Could be things like an external parking lot or things like that. So one of the things the company is exploring is actually severing the land within the portfolio and being able to either sell off those pieces or do joint ventures with developers to do construction on those pieces. The last piece to the puzzle is the company's also very good at adding units to existing properties. So they might convert a swimming pool or a laundry room or things like that. So there's a lot of other drivers over and above this kind of core business. So what I think is, just the core business itself is a really good business to own. And then if you get over the next kind of 5-10 years, this sort of blue sky scenario where you start seeing them doing other things with their properties, I mean, I don't even want to tell you how much it would add to the share price because I just
You have to tell me.
I just don't. Let's just say it would be very material. And if you're going to own a real estate stock in Canada, we only own one. This is the one I think you want to own. It's very well run. CEO owns half the company. So if you talk about alignment of interest, and he's never sold a share, that is what you want in alignment of interest.
All right. We're going to end on that definitive note.
All right.
Jordan, thank you so much for joining me.